5 tips for retiring abroad. These are the 5 most important things you need to know about retiring abroad. I'm Vincenzo Villamena, CPA and founder of Online Taxman. Let's get into it. Number 5, keep your U.S. address and phone number. I cannot stress this enough. You want to have a U.S. address because there's so much stuff that gets lost in the mail. You want to make sure that you're getting letters from the IRS, refund checks, things from your bank, Social Security, etc. It is so important to make sure that you get this stuff. So things like your bank will need to send you a text message in order to verify entering your account or making a bank transfer, and you want to make sure that you're able to do that. I have a client that has to call his 90-year-old mother in order to do bank transfers on his app. That's not a way to live. Just make sure you keep the phone number. And also for banking, they want a residential address, not a P.O. box. So if you want to keep your U.S. banking, keep your U.S. brokerage, I really do advise you to have some sort of residential address from a friend or family member in order to have access to banking. Number 4, what to do with investing in banking if you're going to retire abroad. As I mentioned previously, I do highly recommend to keep your banking and brokerage accounts in place. As a U.S. taxpayer, it's just so much easier to be able to do your investing in the United States and report on your U.S. tax return accordingly. Some banks are better than others. We generally recommend Schwab and Interactive Brokers because those are the ones that work most with Americans abroad. But if you do want a foreign bank in order to transact in said country, like paying rent and electricity bills, etc., no problem, get the bank account. But also know that if that bank account balance ever goes above 10,000 US dollars in 1 year or equivalent, then you have to file what's known as the FBAR, Foreign Bank Account Reporting. It's not something that you're going to be taxed on, but it is something to know that you do have to report your foreign bank account on this form if it meets the threshold, because if not, you could be subject to $10,000 fines and even jail time by the FinCEN, the Financial Crimes Enforcement Unit. It sounds a lot scarier than it is, but it is really important that you make sure that you report everything. You won't be taxed additionally, but you do have to report it. Now, when it comes to foreign investment accounts or retirement accounts, I don't generally recommend that because of, 1, the FBAR, 2, because it's something called PFICs, which are passive foreign investment companies. In other words, things like foreign mutual funds are taxed differently than U.S. mutual funds. And what we've seen is a lot of foreign financial advisors aren't aware of the detrimental tax treatment of things like PFICs, and so they recommend their clients to invest in them, not knowing about the U.S. tax consequences. So although they might be great investment opportunities, they are not generally good because of the U.S. tax treatment. And so in order to avoid stuff like that, or even moving your retirement account from the U.S. to a foreign country, potentially being subject to early withdrawal penalties, I really would recommend to keep most of your banking and brokerage stuff in the United States for just ease of mind and not having to deal with these obstacles while living and investing abroad. There are actually better options to make foreign investments, such as a self-directed IRA. A self-directed IRA essentially is an IRA that allows you to invest in alternative assets, such as foreign real estate, other foreign investment opportunities, even foreign mutual funds. They would not be subject to PFIC rules because they're in a self-directed IRA, so it's not taxable. Number 3, move to a tax-friendly state. Okay, if you are from California, Virginia, Illinois, Massachusetts, to name a few that are states that you want to watch out for, then on paper, I would move to places like Texas, Florida, Nevada, Washington, Alaska, South Dakota, Wyoming, or Tennessee. And by doing so, you will actually save state tax. And so as a retiree living abroad, you want to be able to save state tax. And so by moving to those states, you will avoid that state tax up to at least 10%. So it's a real tax savings for people that are pensioners, Social Security, etc. So then the question is, well, how do I move to a state? How do I cut ties with a place like California? Because it's really about cutting those ties. All right, one, get a new driver's license in that new state. We've seen people go to a place like South Dakota where all they have to do is spend one night in a hotel room and then the next day go to the DMV and show your hotel receipt and you'll be able to get a South Dakota driver's license. Same thing with voter registration. Cut ties with your former state like California, register to vote in a new state. You won't have any ties there that will potentially get you in the end and tie you into paying tax locally in California. Give up any type of long-term lease, or if you own any real estate in a place like California, you either sell it or rent it out long-term, so it doesn't look like you're going back to said home. Of course, that also means not having any belongings in the state of California and moving all those belongings outside. Of course, a mailing address is a big factor. We've seen so many people get busted so many times because they have one piece of mail go into their old California address. It could be a brokerage statement, it could be a social security statement, it could be anything. Okay, but the fact is that because that tax document goes to an address in California, the franchise tax board in California is automatically notified, and then they send a letter to you. I've seen it countless times, and we've always been able to get out of it by showing all these ties that have been severed to California. Same thing for bank accounts. Register the bank account in another state, no address in California. Healthcare and doctors. This is such an important factor. If you're able to show that your doctors are in your new state and you don't have any ties to California, any old doctors there, that's a big way to show that you've moved. So keep any receipts from any of the doctor's visits, and of course sign up for healthcare in that new state so that you could show that you are linked and living in that new state. And same thing with any other sort of what's known as social, cultural, or religious ties. So things like church or any other professional associations, gym membership, even a library card. The more documentation that you could show that you moved to a tax-free state like Florida and Texas, the more you're going to be able to get out of potentially paying California or other state taxes. Number 2, avoid double taxation. And really this comes with being a tax resident in a foreign country. If you're able to achieve tax residency status in a foreign country, either by filing and paying taxes locally, or being able to show that you have a visa there, you have a bank account there, you're showing all those ties that we previously talked about that you're cutting with California or another taxable state, and you're showing that you have those ties with this new country, then you can claim that tax credit on your U.S. tax return. Okay, and it doesn't matter if there is a tax treaty with that country or not, but by living in a country and quote unquote having that income source that country, if you are paying local tax, you would get the credit in the United States. So double taxation could be easily avoided. And finally, number 1 for retiring abroad is really to use the tax treaties to your advantage. There are a number of countries that you could avoid U.S. and or local taxation on things like Social Security benefits due to the tax treaty. And as you can see on the screen, there are several very desirable places that have very strong tax treaties in the United States that specifically offer unique tax relief for Social Security income. Ireland, Italy, Romania, Portugal, Australia, Canada, the UK, Israel, and Germany. All these countries and some more offer this unique tax relief on Social Security income. So do your research, do your homework, talk to a local tax professional, talk to us, and we will help you figure out what your tax obligations are when you move abroad. And when you reside in these countries, the U.S. cannot collect Social Security tax, as I mentioned before. I'm Vincenzo Villamena, founder of Online Taxman, CPA. So if you have any questions about retiring abroad, please book a consultation and reach out. Thank you.